Hello everybody, my name's Harry Thompson and I'll be running through the third quarter update with you today. On this slide you'll find the usual disclaimer. Just wanted to point out that we have sent out a number of documents in the last couple of weeks covering performance commentary. If you haven't received those, please get in contact with your King Shaxson representative and we'd be happy to get those forwarded on to you. A year ago, UK markets were recovering from the disaster budget of Liz Truss that caused havoc in the gilt market and threatened liability-driven pension schemes. Although the scare itself and the politicians responsible were replaced, the gilt market and the global market staged a short recovery. However, since then, global bonds and gilts have fallen back towards the low seen in September 2022, with the UK 10-year yield at 4.44% at the quarter end and rising to a high of 4.67 post-quarter. As seen in the chart on the bottom right, inflation continues to trend lower, whilst global growth expectations have been reduced around the world. Notable major risks are property in China and the auto sector in Europe. The rally in equities has only been driven by a small number of technology stocks, once known as the FANGs but now referred to as the Magnificent Seven. Markets outside of those stocks have been more muted in 2023. The market is contending with the higher for longer stance with regards to interest rates. The rhetoric from the September Federal Reserve meeting only confirmed this outlook, particularly the fact that interest rate cuts have been pushed further down the road. The oil price around $90 a barrel has reignited some inflation concerns as well. Investors are contending with lower central bank buying of bonds at a time when traditional asset managers have largely allocated to the asset class, whilst bond issuance, fueled by government deficits and corporate credit, are on the rise. Due to the above, the rhetoric and market reaction has firmed over the last few weeks. This is reflected in the steepening of yield curves, including the UK, with the graph showing the move from the end of August, the yellow dotted line, to the end of September, the thick green line. Over that 1 month period, 30-year government debt added around 30 basis points to once again trade near the Liz Truss mini-budget highs. Higher interest rates are something only those with a quarter of a century of experience will remember, but we will certainly feel the market is past grappling with this and other factors need to be considered. When it comes to fixed income, much of the pain for lower risk investors has been felt. Our timing was premature when we added to fixed income last year, and we corrected this and have been in a position in model portfolios where we have been in the duration region of 4 to 5 years. We feel the short end of the market has offered opportunities, particularly as the yield curve steepens. We are not yet in a comfortable position to be adding to duration again, but we are just above our neutral allocation level and do have room to manoeuvre higher, but at the expense of other asset classes. Bonds are viable for the first time in a number of years, and when the volatility subsides, will provide investors that negative covariance against risk assets that the textbook tells us they do. Staying with fixed income, let's take a look at the supply and demand dynamic a little closer. Increased investor demand for the asset class coincided with both increased government and corporation credit supply. Therefore, the fears of some about the end of QE and its impact on bond markets did not materialise last year. Whilst demand from traditional asset managers or real money accounts has been largely fulfilled, government and corporate issuance remains high, and the current market turmoil is as much about high supply and low demand as it is about interest rates. In the US, the Federal Reserve continues to reduce its balance sheet, down from circa $9 trillion in 2022 to $8 trillion at the time of writing. The graph shows the extent to which this is set to continue, although there is no expectation for them to shrink it to pre-financial crisis levels of sub $1 trillion. In Europe, the French and Italian governments have faced criticism for their budget deficits, and the recent political brinkmanship in the US that almost led to a government shutdown are all signs that bond vigilantes are gaining the upper hand. The much higher cost of debt for governments is only adding to the deficits that governments seem unable to rein in. Therefore, bond market direction is now less about interest rates per se, and more about lower real money demand and high supply. With evidence that the global economy is slowing in many key areas, the interest rate narrative may become more dovish sooner, certainly for short-term interest rate expectations. Whilst we do not expect a rerun of the sovereign debt crisis in 2013, there are some similarities with the current dynamics that should not be ignored. Whereas gilts and bonds were very public victims of the Liz Truss market scare, they recovered shortly afterwards. Two other interest rate sensitive asset classes, property and infrastructure, also fell but have not recovered, and both posted losses for the last 12 months. Whilst persistent inflation and higher longer rates continue to lead to volatility in the infrastructure sector, critical renewable energy infrastructure has faced continued negative sentiment, given the concerns over higher rates impacting companies' ability to execute against the development pipelines. Concerns were further sparked in September following the announcement from NextEra Energy Partners, a company focused on clean energy projects such as wind and solar, who have reduced their distribution growth outlook, citing tighter monetary policy and higher rates impacting their project financing. Their share price dropped over 50% in a week and led to a souring sentiment in the sector, as it raised doubts over peers' ability to deliver construction projects. Within the model portfolios, we have favoured infrastructure investments into operational assets and less so into the construction aspect, although there is some exposure. We continue to engage with managers in this sector, as well as analysts from major banks who supply us with research, and the continued rhetoric is they offer excellent value. We are under no disillusion as the drag this asset class has had on portfolios. These assets continue to trade at a high discount to their net asset value, and this reflects some expectations valuations may fall as their cost of debt rises, whilst the higher discount rate negatively impacts DCF models. Whilst NAVs provide a guide to investors of asset values based on various models and assumptions, the value of an asset is confirmed upon a transaction or sale. Recent asset sales have largely supported the valuations, meaning other supply and demand dynamics are at work. Nonetheless, we feel much of the damage has already been done, which is why we remain convicted to this asset class, given we feel we would be selling at the incorrect time. The rise in yields continued to place pressure on equity markets in general, with the all-world equity index declining 4.1% in dollar terms in September, which follows on from the circa 2.8% decline in August, making the third quarter a negative period for global equities. Underneath the bonnet, large cap and value continued to outperform small cap and growth equities. The weakness in September did feed through to the Magnificent Seven, which is the names such as Facebook or Meta, Apple, Amazon and Alphabet. However, their impact on global equities has had a significant impact on performance over the year-to-date period. The graph highlights the total return in US dollar terms of the Magnificent Seven, returning circa 84% based on the equal weighted index. If you remove these 7 stocks from the index of 500 companies, one of the US's main bourses, the remaining 493 stocks would have seen the index return a negative value so far in 2023, highlighting the dominance these stocks have had on US and global equity returns. As mentioned in our previous updates, this has been particularly tough given our avoidance of names such as Apple or Alphabet or Amazon. We've had very limited exposure to names such as Microsoft and even less to AI-focused Nvidia. We've been quite clear over our rationale for avoiding the so-called FANG stocks, and it is important clients understand the impact of this screen. This has meant an increasingly concentrated top end of the US market, which has further exacerbated the weakness on smaller companies. You can see reasons for this weakness given the rising cost of capital and rising wages that inevitably take a bigger toll on less capitalised names. Nonetheless, we have reached the point where valuations for US smaller companies are at their most compelling levels in decades. Whilst the looming recession is a headache for timing, it is likely we are going to avoid a so-called hard landing, and history would suggest an unwinding of a high concentration in large caps would benefit small names, and this is something we continue to monitor closely. Capital discipline demands a higher risk premium for equities. This has led to far fewer companies coming to the stock market, as more realistic valuations are demanded. The relisting of ARM in the US and 2 tech IPOs in the same week took place at lower than initially expected valuations. As the delayed reaction to interest rate rises now hit home, especially a risk in the UK mortgage market, it has led to a more defensive posturing in markets. Following the announcement that the OPEC Plus cartel would maintain supply cuts, the price of oil has continued its trend towards $100 a barrel, the blue line in the bottom left graph, and with it the share price of many within the sector. the white line being the global oil and gas index. Whilst we do not want to sound like a broken record, it is an important factor to note. Our model portfolios apply a strict screen, such as fossil fuels, but also areas such as defence and tobacco. Over the last few years, these sectors have been some of the strongest performing at times, particularly energy and defence given the geopolitical landscape. When this happens, it can lead to a period of underperformance versus the general market. This has been exacerbated by the war in Ukraine and the inflationary pressures brought about in the post-COVID recovery. As policy has tightened, and as we have alluded to earlier, renewable projects have been weighed down by the higher cost of capital. Certain renewable projects under construction have hit the headlines for being halted due to spiralling costs, which has been a product of the previously ultra-competitive bidding landscape, leaving little margin for error. We are now seeing this reverse or be rebuked, as developers focus on high-yielding opportunities. This was evidenced at the latest UK wind auction, which saw 0 bids received given the guaranteed price for electricity was too low in the face of higher raw material costs. We are hopeful this will be a large wake-up call and prompt action at a critical time, and support developers in achieving more realistic returns and more sustainable longer-term growth. Nonetheless, with less projects in the pipeline and legacy backlogs to work through, equipment manufacturers such as Vestas Wind Systems have been placed under pressure. Meanwhile, a $1 billion impairment by Ørsted, who is one of the largest offshore wind operators, due to supply chain problems and higher rates, has further weakened sentiment towards the sector. This has been reflected in the Clean Energy Index returning -27% year to date, and given portfolios' exposure to this sector, they've been placed under renewed pressure, just as we felt supply chain issues were being worked through, and subsidies from legislation such as the Inflation Reduction Act were beginning to feed through. However, we do see opportunities, as I will touch on the next slide. Climate action and affordable and clean energy are goals of the United Nations Sustainable Development Goals, and the model portfolios have a number of companies aligned to them. Over the last few months, we have experienced unprecedented sea and land temperatures, with the average surface temperature in September 1.75 degrees warmer than pre-industrial levels. We are off track to meet our targets and climate action is critical. However, there is a lack of business certainty and support. As we mentioned in a previous update, the International Renewable Energy Agency, in their World Energy Transitions Outlook for 2023, showed that we are currently projected to fall short by 1.7 trillion per annum in investment to reach the 1.5 degree scenario by 2050, as highlighted in the image to the right. The Intergovernmental Panel on Climate Change, in their 6th Assessment Cycle Synthesis report, states that observed temperature increases are unequivocally the result of greenhouse gas emissions resulting from human activities. There is a clear need to have a just transition away from fossil fuels, with climate change representing a number of risks. Mitigation, adaptation and development is required, but will need capital to flow into resources and solutions. Public support, such as the US Inflation Reduction Act or the EU's Repower EU or Green Deal Industrial Plan, provide this, and here is where the investment case lies. A large number of companies within the portfolios are developing and applying innovative solutions to issues such as clean energy, but also areas such as medical technology, water, mobility and waste management, just to name a few. Portfolio holding Vestas Wind Systems saw a 4-year high in US orders in Q3 as fiscal stimulus begins to take effect. We feel the market is over-discounting these stocks for the above issues, but you only have to look at the order intake to see the huge demand some of the portfolio companies are receiving for their products. Many of these companies are longer duration plays, i.e. cash flows further down the line, which are greatly impacted in analyst DCF models. However, we feel we're approaching a turning point in this story, providing a hard landing is avoided. The interest rate scenario will play a big role, and as highlighted, we feel this will begin to turn around and become more dovish due to a discounting of a policy mistake. Whilst not wanting to overcommit, we sit around our neutral level for equity exposure, but well positioned to benefit from a pivot scenario. Post-quarter end, we have seen some green shoots appear of a rotation back into some of these unloved sectors. Even those old enough to remember high interest rates, they did not have to contend with quantitative tightening, supply chain shifts, and changing technologies that are all front and centre at the moment. We see many impact themes which have been battered over the last 2 years as unloved, but offering some growth potential, as markets readjust to a new normal with much higher capital discipline. AI, medical technology, healthcare are all sectors that the market is focusing on for growth. Renewable energy continues to suffer from supply chain and cost issues, but the order books are growing and we expect a rotation back to this sector in the coming year. The search for genuine growth and technological change will dominate growth investing, and quality will dominate value investing for the immediate term. As mentioned, post-quarter end, we did see some green shoots of people returning to these unloved asset classes. This was driven by welcome comments from Federal Reserve officials in recent days, which has been more of a dovish stance, suggesting that the higher yields mean less need for the Fed to raise rates. Pricing for the US Fed funds rate would suggest we are very close to peak rates, and this hasn't changed a great deal in the last few weeks. However, peak UK rate expectations have dropped by around 30 basis points over a similar period. We continue to believe the interest rate narrative will get more dovish sooner than expected, given the slowing economy as higher interest rates take their toll and the prospects of a policy mistake continue to mount. We have previously commented on our concerns over the UK. Whilst the US remains fairly resilient for now, let's not forget some of the US consumption is being supported by student loan moratoriums and state-level tax breaks which are beginning to be withdrawn, whilst US mortgages are at a 2-decade high. Well, that brings us to the end of the third quarter update. Thank you for listening. If you do have any questions, then please feel free to reach out to your King Shaxson representative and we'll be happy to help you.